love the channel and find it useful in becoming a happy retiree. Subscribe today. A missile launch from North Korea towards Japan, targeting Japan, evidently lands in the ocean. I love the report that continued to say towards the economic region of Japan, and it didn't hit anything, evidently landed the sea, and the markets didn't even ripple. I thought that the Dow would be down 500 points as soon as I read that. Wait a minute. Nothing. No reaction. Nothing. No reaction whatsoever. Maybe it's because the U.S. already spends more on defense than the next 8 countries combined. Maybe that's it. Maybe we just have no fear of North Korea. Maybe we look at North Korea and we're ready just to pounce, as if similar to how a child would think about it. My children, they wake up to Yahoo News or something on the computer and they'll say, "Dad, they just launched a missile. Is this a scary thing?" And they say, I say, probably not, because we can deal with North Korea. And they say, yeah, we can just wipe them off the map, right, Dad? Maybe that's the exact same thing the stock market thinks. Maybe the U.S. is not scared of North Korea at all, and we're ready just to do something. The House just this week passed, by the way, an almost $800 billion bill to increase the Pentagon's budget and build a U.S.-Mexico border wall. Maybe, again, that's another reason that we continue to be so superior to countries like this that we're just not worried about it. Maybe that's it. Of course, that's a stay tuned as things develop on that. Healthcare, every way you slice it, repeal, replace, whether it's the skinny package, the healthcare a better way, you name it, dead on arrival. All of it gone. As I said, what happened last week, it's exactly what happened this week. No movement. It's completely dead now. Healthcare talk will go into the abyss for now, and we're going to move on to taxes. We're going to move on to this giant PR tax tsunami as the Trump administration is going to sell what's newly important for the economy, and you're going to be hearing a lot about it over the next 3 or 4 months, really up to the end of the year. We'll touch on that. But that's the next step here. We move on to taxes. Next this week, the Fed did essentially nothing in the July meeting. It just met this week, came out, said, look, we're not going to do anything. And you know what? That's fine. They are still waiting for inflation. Well, how about earnings? Well, earnings, among the biggest stories this week, and really it's the underlying current and the tide and what really matters to markets. Boeing up 14% after a huge earnings report. McDonald's did the same thing after besting numbers up about 1.4% on the week. Caterpillar, solid numbers, up 5.5% on the week. And Samsung, if you take a look at Samsung, record profit and record revenue. Samsung has been known for more volume than Apple with their smartphones, but lower profits, less margin, etc. That's probably going to change, though. This quarter was enormous for them. $55 billion in revenue, $12.5 billion in profit for the quarter. Apple is coming up this week in earnings season, estimated to have done about $45 billion in revenue and $10.5 billion in profit. So both of those stocks have had a huge run this year. Apple up 29%, Samsung in terms of their local currency, the yuan, up around 32%. Both stocks doing very well. So this is the world that we live in. We are still, what trumps all of the discourse in Washington and all of this, let's call this a new political low of nothing and nothing and nothing getting done. The fighting is at a high. The political conflict index is close to an all-time high, which is a real political index that gets measured now by the Philadelphia Fed. We talked about this a couple of weeks ago. As bad as Washington has gotten, the market just continues to discount it and moves right on. The reason, a big part of the reason, has to do with these very important earnings reports that continue to come out. So you get companies like Boeing and McDonald's and Caterpillar and Samsung, they blow earnings out of the water. That's really what the market cares about. And we're going to continue to see that. We are probably, or we're close to about halfway done earnings for this for second quarter 20, what's getting reported today, second quarter 2017. we're already about halfway done, and it looks as though we're going to get yet another quarter of double-digit growth. The first quarter, we had 15% earnings growth from that time over the previous year. This quarter, we're going to get another 12 to 13 to 14% growth. So as a whole, the earnings recession is over. The earnings recession that was 2014, flat earnings. 2015, flat earnings. 2016, flat earnings. Again, effectively profits from companies in the S&P 500 going virtually nowhere for 3 straight years. That's officially behind us. You get a 15% first quarter 2017, you get a 12 to 13% second quarter 2013, and all of a sudden you look at the market and say, well, S&P 500, is it undervalued? No, by any historical measure, it's not. It's not as though we're trading at 10, 11 times profits. We're trading closer to 18. Let's call that fully valued or slightly overvalued, but by no means enormously overvalued. And that might be, and that is very likely, a big reason why here we are at the end of July, and we get a stock market that continues to be higher and grind higher and grind higher. And that's exactly what's happening. For the week, the Dow up about 1.1%, S&P 500 essentially flat, NASDAQ down 0.2%. Year to date, the Dow up 10.4% and the S&P 500 up, again, 10.4%, similar to the Dow. The NASDAQ up 18%. Let's talk a little bit about gross domestic product, which, by the way, just got reported this week for the second half of 2017. More Goldilocks numbers. So we've been getting used to this for 8 years now. 2.6% is actually a little bit on the high end from what we've gotten used to, but still very much in this not too hot, not too cold environment. Really just kind of a frustrating number for Americans to get used to or for our economy to grow at. Doesn't quite do the job. Now, it's not I'd take 2.6 over negative 2.6 all day long. We've added back millions of jobs during this economic recovery since the great recession of 2007 and 2008. But I'll reiterate, until we get back to 3 to 3.5% range, which is, we're not going to be comfortable as an economy, as a workforce, as a labor force, as families, as a nation, until we get back to that range. For almost 50 years, we grew in America at about a 3.1% per annum GDP, gross domestic product growth clip. 3.1%. Since the Great Recession, despite the recovery that we've gotten, we've grown at a 1.9% clip on average. Now, that might not sound like a tremendous difference. Hey, Wes, isn't that really just saying we've gone from about 3% down to 2%? It's really not that big of a deal. Well, not when you really do the numbers on a nearly $20 trillion economy. It's a very big number. 3.1 down to 1.9 is a 35+% deceleration. That's how we're going that much slower. Let me give you an equivalency or an equivalent in miles per hour. That's the equivalent of going 60 miles an hour, and that's what we got used to for, let's call it, over 40 years on the highway for a cross-country trip. Let's go from New York to LA. It's about 2,800 miles. And I got used, I'm going 60 miles an hour almost the entire way. And then when I have 400 miles left, so I'm almost done the trip, but still 400 miles. Now I've got to slow down to 39 miles an hour. From 60 down to 39. You've got to go 39 for the rest of the way. Imagine the frustration that you'd have behind the wheel. That's what's happened to the pace of growth in America. And we're experiencing that collective frustration right now. That's a giant part of why why the political environment, not just here in the United States, but around the world, with the rise of Trump and Bernie Sanders and Le Pen and nations across the world, that voters and the population is just frustrated. And there's this underlying grimace that's continuing to bubble up and groundswell. And we're seeing it here in the United States. It may get glossed over with the number 2.6, doesn't sound all that bad. And it's really not terrible, but it's just not enough to lift Americans out of middle class, out of the same wages that we've been seeing for decades and decades. And that's exactly what's happening here in America. One thing that's always true in markets, and it's very rare that I can ever say anything absolute about markets, and that is a concept called reversion to the mean. Reversion to the mean, it just means that stocks can't and won't grind higher and higher and higher without some sort of pause. Now, it doesn't mean that stocks aren't going to finish the year higher, and we might very well, and we have a high likelihood, and if you go back and look at 5 years that, if you go and find 5 separate calendar years that have a similar low volatility pattern at the beginning of the year, 5 years that look the most like what we've seen so far in 2017, we end up the final end of the year higher, but volatility picks up in every case. And quite frankly, there's almost no way for it not to pick up, because it's setting records of low volatility. So again, it doesn't mean that we're not going to see and grind, stock markets don't eventually grind higher by the end of 2017, but just don't expect a ride without some speed bumps. Now, the other thought here is that we're going to continue to keep a good eye on what I really believe, I'm going to just call this the Trump tax reform book tour that we're about to start hearing a lot about. Sources in Washington, my sources, have noted that there's a tremendous amount of work that's being done right now on tax reform. And this time, instead of flailing on the marketing selling side of the equation, I think you're going to see an administration that is really going to bring it from a public relations standpoint. It's going to be a tax reform tsunami, from what I can tell. So healthcare, it just, first of all, they did our leaders, let's say, Congress did a really bad job of selling to the public the new healthcare proposal. For the most part, I understand that, because I don't think they had a real solution. Healthcare is just so complicated to get right, and there's so many different families and situations that are involved that it is an impossible case to make everybody happy. So I don't think they had a great solution to begin with. It's kind of like trying to sell a new book or a new movie with a bad title. It just doesn't work. But the new book they're trying to sell is a lot easier. The title on this one, it's really simple. It's just lower taxes. If it had a subtitle, it'd be how to put more money in everyone's pocket and grow everything under the economic sun. That's a book that'll hit the bestseller list. And that's exactly what is brewing right now in Washington. They released a one-pager several months ago, and it really had a chapter for everyone to get excited about. So American families love the prospect of 1% to 3% lower tax bills. CEOs love lower corporate tax and a repatriation holiday. And business owners love the idea of all the components that could be in the new reform. So we're going to hear a lot more of that in the coming weeks. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.